Alright, so this is our first real lecture, which is on Chapter 1, which is just an overview of finance in general. So we'll start with the question, what is finance? I like to say finance is about decisions about money. So how do we decide how to raise money, how do we decide how to spend it, how to save it, and so forth. So businesses have to decide how they get to raise money. People have to decide, are they going to take a mortgage or not? How are they going to save for the future, and so forth. And that's basically what finance is. It's not a trivial question by any means. Money's obviously important, but if you look at some statistics, there's different numbers. Some say that a third of all small businesses fail within the first 2 years. Others say within half of all small businesses fail. These are different numbers out of the U.S., but a large percentage of small businesses that are new fail. And the reason they fail is they run out of money and they have to go bankrupt and shut their doors. So making good decisions about how you're going to spend your money and raise your money could be the difference between surviving as a business or not. It's more than that. We also talk about investments in general, which is we get into theory about time value of money. What should money earn over time? What should you earn for putting off spending today and spending in the future? What should you earn for taking risk? We talk about how inflation affects things like that. Let's also talk about the difference between finance and all the other business fields. So things like accounting, finance, econ, what's the difference between them all? They're all interrelated, obviously. Finance is, I like to think of it as applied general business skills. So accounting, for example, it's probably the easiest to get a job in because everybody needs accountants. People need accountants as CPAs, certified public accountants. Every business has accountants that are hired, and it's for bookkeeping at its core, which is making sure you keep track of all your expenditures and bringing in money and everything. Finance is a little more applied, which is we take that bookkeeping and we decide how we can use it to make future decisions, things like that. Econ's even the most abstract of all of them, which is probably the hardest to get a job in because maybe it's the least directly needed, but it looks more theoretically at maybe the overall economy and why nations why nations succeed or fail, and it looks at supply and demand. It looks also at microeconomics, why individual firms succeed or don't. It looks at sort of the theory behind why markets go up and markets go down. Finance more looks at actual prices. So we'll go out and look at interest rates. We'll go out and look at stock market prices, and we'll just say, all right, given that that's correct, how do we use that information? So it's a very applied field. All right, so next we'll talk about what kind of jobs there are in finance. There's several different fields you could go into. One would be what we'd call corporate or managerial business finance, which is you're going to work in a firm and you're going to make financial decisions, help people make financial decisions. So we'll have several chapters towards the end of the course where we talk about very specific different decisions that firms have to make, like capital budgeting. So what projects are they going to take? How do we decide if a project is a good project or a bad project? Leverage decisions. So how much debt are we going to have? The more debt you have as a firm, the more risk you take, but the more return you should get as an owner of that firm. We'll talk about the trade-off. Payout policy. What do you do? Do you pay dividends? Do you repurchase stock? Those are typical corporate decisions they have to make. Even more minute things like payable and receivable management. What kind of credit terms are we going to give to our customers? If they want to buy on credit and pay us 30 days later, are we okay with that, or would we rather them pay us in 20 days? Those are finance decisions. Has to do with, do we receive money today, or do we receive it in 10 days, 20 days, 30 days? All those kind of decisions go into the corporate finance category. Then there's financial institutions, things like the commercial bank. That's the most standard financial institution everybody knows about because that's where you deposit your funds. commercial banks have a huge role in the econ of any economy. They take in deposits, they pool all those funds together, and then they make loans with those funds. So they make loans for small businesses, they make loans for people to have mortgages so they can have a home, and so forth. And more than that, they actually have a role in creating money and deciding what the money supply is going to be and how fast the paper economy versus the real economy expands. A lot of that money creation stuff is a little beyond the scope of this course. That would be in something in a money and banking course or a financial markets institutions course. We'll talk a little bit about it. And it's a very interesting topic. But if you go into that field as a finance major, you're probably going to start as a loan officer or something, where you decide who gets a loan or not, whether or not it's good credit risk, things like that. Then there's the financial servicing industry, which is similar, which is where you help people buy a home, you help people plan for retirement, you help corporations manage their pension fund, things like that. So you provide some sort of financial service to some customer, it's tailored to them and so forth. And then there's sort of the investments field, where you help people make portfolio decisions how to invest for the future. So do we want to be diversified with our portfolio? Do we want to take on risk with our portfolio? How much risk do we want to take? The more risk you take, the more return you get. We'll talk about that later. And that all kind of fits in the investment side of things. And it gets you can get down into what we call investment banks, where they bring new securities to market, and then they become what we call a market maker, which is where they trade securities that they took to market and things like that. And then they offer analysis on the stock market, which stocks they think are going to go up and things like that. That all fits under the investment framework. All right, next let's talk about the different ways that a business can be organized. These are basically different legal entities. So you could get real complicated with this lecture if you wanted to get into legal finance, but we're just going to give you the basics, which is there's trade-offs between being a simple company that has small number of owners and a large company which has a bunch of owners. Okay, so let me scroll down a little bit here. For example, a sole proprietorship is just a single owner, and these are different legal names in different countries. This is going off the US, but it's basically the same in most countries across the world. So a sole proprietorship from the tax services standpoint is no different than the person who is the sole proprietor. So I can go out and start a business if I want and I could start making widgets or whatever in my living room and sell them, and I put it on my own tax return, and there's no difference from a legal standpoint between me and my business. That's called a sole proprietorship. If you take a step up, there's a thing called a partnership, which is what if I want to have multiple owners of the same company. If they're all general partners, then it's basically just like a sole proprietorship. We just break up the business by the percentage that we both put into it. So if I want to bring a partner into my sole proprietorship and I put up 75% of the initial capital, the money to raise to start the business, I get 75% of the profits, he gets 25%. And we just split it up like a sole proprietorship, but we own partial amounts. The main problem with being a sole proprietorship or a general partner is that you have what's called unlimited liability, which is, let's say somebody walks by the front of my coffee shop, stubs their toe, breaks every bone in their body, and then sues me for $3 million and wins. Well, I all of a sudden owe him $3 million. I might not have ever put anywhere near $3 million into the business. I might only put $100,000 into the business, but now I'm liable for $3 million. Well, I don't have it. But what will happen is, since I'm legally inseparable from my business, they won't just go after the business assets, they'll come after my assets. They'll come after my house, they'll come after my future wages, they might take my car from me. That's called unlimited liability. I'm liable for anything that happens to my business. People don't like that, obviously, to be unlimited liable, so they've created legal entities to help reduce that risk. The government likes to encourage risk-taking. The more businesses are created, the more jobs are created, the more the economy expands. But if everybody's mega liable for everything they do, they're not going to create businesses. So they have ways of having what's called limited liability. One way is to be what's called a limited partner. So you go into a partnership, and the only thing you do is contribute capital. You put some money into the business, and the worst that could happen is you lose the money you put in the business. You can't lose any of your personal assets. In order to be a limited partner, you have to not be involved in the day-to-day operations of the business. All you do is provide capital. So you're just a limited partner. A corporation is like an extension of the limited partnership where everybody's a limited partner. So take Microsoft, for example. Microsoft sells shares, and the nice thing about being a corporation is it greatly expands the way you can raise money, and that you can take these shares and you hire an investment bank, and they go out and they market these shares to thousands, or if in the case of Microsoft, hundreds of thousands of investors, and you can raise a whole lot more money. If you want to just be a limited partnership, you can only have a couple partners. But if you want to be a corporation, it's like everybody's a limited partner. If you go out and buy a share of stock in Microsoft, technically you're an owner of Microsoft. At most, you can lose, if Microsoft goes bankrupt and owes $1 billion to somebody, they can't come call you up and take your house or anything. All it could happen is your share of Microsoft stock goes to zero. So you're all limited liability, and that encourages risk-taking. Corporations encourage capital formation so that people put their money into businesses, expand the economy. The trade-off of doing that is that you're much more regulated. If you become a corporation, you have many more rules you have to follow. You have to follow all the SEC's rules and the Federal Reserve's rules and things like that. But the point is, if you're a limited partnership, if you're a partnership with a limited partner, things are relatively simple from a legal standpoint. When you become a corporation, you got to follow a lot of rules, and you're limited as to what you can do and can't do. Then there's various hybrid corporations that kind of fit in the middle of that. For example, an S corporation is a corporation that doesn't have that many shareholders. The limit, I think, is 100 shareholders in the U.S. And they can't be public shares, meaning that they don't trade on the public exchanges, which we'll talk about later. They only trade privately amongst in what's called the over-the-counter market, but it's not covered by the SEC, basically. As long as you keep your number of limited partners, your corporation small enough, you can get around the biggest problem with being a corporation, which I haven't mentioned yet, which is what's called double taxation. If you create a corporation, this isn't true of a limited partnership. With a corporation, it's from a legal standpoint, it's like creating another entity. It's another taxpayer. It's like a person was created from a legal standpoint. And that person has to pay their own taxes, their own income taxes. So if you're a corporation, you have these 100 owners, and then you have the corporation, the legal entity. The legal entity pays its own income taxes, then they dish whatever's left out to their owners, and then the owners have to pay their own income taxes. So you're taxed twice. So from a cost of capital standpoint, how much it costs you to fund your money, once you become a corporation, there's a big hit there. S corporation gets around that. You keep your company small, you don't have to pay double taxes. The corporation doesn't pay taxes as an income taxpayer, only the owners do when the profits are dished out. Limited liability companies, similar deal. It's not doubly taxed. In England, they have a thing also called a limited liability. They're different nomers. We call them LLCs in the U.S. They call them LMDs in England, but they're the same idea. Limited liability companies are even smaller than S corps, but they're all based on the idea of if you keep your company small enough, can you get the best trade-offs? I have a little chart here, which will help you kind of remember all this, which kind of puts in a grid here, the trade-offs. So you have sole proprietorship, partnership, corporation, hybrid, and you have the different things that are good. So limited liability, sole proprietorship, partnership, you don't get that. Corporation, hybrid, you get that. Unlimited life, we didn't really talk about that, but sole proprietorship and partnership dies when its owner dies. Corporation, hybrids, again, they're their own entity. They go on even after the owner dies. Less government regulation, that's going to be the simpler ones, sole proprietorship and partnership. No double taxation. Corporations, the big problem there. They're doubly taxed. All the others try to get around that. And then ease of regulation. Corporation, that's a problem. If you're a corporation, you're much highly regulated, more than the other forms.